Welcome to Financial Solution Advisors Market Update. If you're not aware, we do this every quarter, which gives us a lot of valuable information. With me today is one of my business partners, Isaac Brohinsky. Isaac, just a little bit about myself. I'm Shelley Linger. I'm the CEO here at Financial Solution Advisors. Isaac is a partner, is amazing, and has some really good information for us today. Isaac, you want to kick us off?
Thank you, Shelley. So as we head into the third quarter, we're waiting and watching and want to see what happens here. First big question is inflation going to finally slow down enough that the Fed can give us interest rate relief? I think everyone's been watching that, waiting to see what happens. Everyone was kind of hoping for that in the spring. We didn't see that. But we're watching and waiting to see if that's going to happen now. The other question is if there's going to be continuing softening in the labor market. We'll talk about that a little bit, what that means, what we're actually seeing there. And then probably the biggest question that's on everybody's mind is what is going on with the equity markets. So if you were to look at what happened over the second quarter, when we started out in April, things looked kind of rough. We got through April, we were looking at the market, we were wondering what's going on here. I think a lot of people were disappointed that there wasn't any rate cut in the spring. But then what we saw going into May and into June was a turnaround in the market and a little bit of recovery. And that was mostly driven by tech. So if you look at what did well, the NASDAQ did really well. The Dow Jones a little bit struggling, a little bit behind. But that's because it was tech driven, a lot of AI frenzy, a lot of people looking at chip makers and how well they may do in the future. So if you look at this, we've seen a significant increase in the value of a handful of tech stocks, and that's what's been driving the market. In fact, we've seen some incredible jumps in market capitalization, which have us wondering if these companies are writing checks that their earnings can't cash. So what do I mean by that? When we look at companies, we look at various things as far as their financials, their growth, what they're able to do, what we expect for the future, things like that, of course. But we also look at some of the fundamentals like their price to earnings ratio. So how much are investors expecting that company to make? And because of that, how much are they willing to pay for that company to own a piece of it? And let me give you just an example. So let's say you want to go out and you want to buy a business so that you can make some money, and you look at some businesses that are for sale and you find one and they promise you if you buy this business, you're going to make $1 million a year. Well, that sounds great, right? Who's not going to do that? Who doesn't want to make $1 million a year? Now, let's say you go to buy that company and they say, that's great, we'll sell it to you for $50 million. Now the question is, who's going to do that? Who's going to pay $50 million for a company that only makes $1 million a year? You probably wouldn't be very likely to buy that unless you thought you could turn around and sell it for $55 million. So you're really looking for that growth in price. You're not really looking for what that company's actually able to earn you. And so when we look at these, when we look at the PE ratios for these companies, we really have to wonder, is their earnings going to be able to bear that out? Or are they, potentially building a little bit of a bubble? So that's some of the things that we look at when we're analyzing that. One of the things that really could brighten the long-term outlook is interest rates. Again, we've been watching this for a long time. When is the Fed going to cut the interest rates? So if interest rates come down, then that gives companies an opportunity to borrow at lower costs so they can expand their operations. They can do it for cheaper. Let's say they have a bad month or a bad quarter. They can finance their operations without having to do big layoffs. So when interest rates are low, then money's easier to come by. It makes it easier for companies to expand and to grow. What we've had and what we've seen for a long period of time is an inverted yield curve. What that means is that if you look at the interest rates for loans, for investments, things like that, if you look at it, especially here with the Fed rate, at what we expect it's going to be for the next month, the next 2 months, the next 3 months, and what lenders are willing to charge as an interest rate or to take as an interest rate, we see this 1 month, 2 month, up to 6 months. is much higher than that 10-year, 20-year, 30-year. Typically, you would think if you're going to lock up your money for a long period of time, like 10 years or 20 years, you would really expect a higher return than something that's just for 1 month, because it seems like there's not a whole lot of risk in that 1 month investment. So generally, normally, you're going to see higher interest rates over longer periods of time. So the inverted yield curve, where we have higher interest rates for just those short period of times, and then we're expecting those interest rates to drop, the reason that's been a red flag for the market is because typically what happens is when we go through a recession, or we go through a drop in earnings, and people becoming unemployed, one of the tools in the Fed's toolbox is to cut interest rates. Again, that makes the money cheaper. It allows companies to expand, grow, and hire. And so when we see this inverted yield curve, it's basically been in the past a big signal that we're heading for trouble with the market. But are we actually heading for that trouble? Part of what comes with that is a spike in unemployment and a drop in the available jobs. Typically, when we see that, then that means we're going to be heading for a recession. It means consumers can't afford to continue the lifestyle that they've built, which means they're going to cut back. They're not going to buy as much. Companies aren't going to be able to produce as much, and they're going to have to lay people off. And the more people they lay off, the more consumers who can't purchase those items anymore. And so we've typically watched to see when unemployment starts to really spike, when the number of open job openings drops, and that's typically been a good signal of, again, just like the interest rates, we're heading into economic trouble. What we've seen now, which has been a lot different than what we've seen in other high interest environments, is that we still have about 8 million job openings. We still have unemployment at 4%, which means that if somebody leaves their job, if they're laid off from their job, or if they're just seeking another opportunity, those opportunities are out there, and employers are having to pay more in order to keep good talent. And as long as that continues, consumers are going to continue to spend and continue to buy. So what that means is that if this were to continue, and if prices were to continue to go up significantly, we could go into a worst case scenario where the Fed has to raise interest rates again. What we're seeing instead is we're seeing inflation continuing to trend down. Now, it's not quite to that 2% range where we want it to be. So we don't have really an impetus for the Fed to do significant rate cuts. But what we have seen, and the signal from Chairman Powell has been that he's not going to wait until it hits 2% in order to do rate cuts. And basically the way that he put it is, if inflation hits 2% and you haven't cut rates, you're probably too late, and we're probably going to head into something like a recession. So we expect that those rate cuts will come, as long as this inflation continues to trend towards that desirable 2% level. What we'll probably see is a quarter cut, or maybe even a half point cut, but it's going to be more of an adjustment than any sort of drastic rate cuts. Now, we all want those drastic rate cuts because we've really gotten used to that 0% rate, for a long time, from about 2008 to about 2018 or so. We saw those super low rates. It allowed us to get mortgages at 3%. It allowed us to, finance new cars at 0%, or 1%. It really allowed us to spend a lot more money very cheaply. And so we got used to that. For a long period of time, we had rates bouncing off of zero. We started to get those rates moving up, moving in kind of a normalizing direction, try to cut off inflation before it started to get bad. And then COVID happened, and we dropped those rates right back down to zero again. So for a long time, we've really been used to that. But if you look at the average going back to the 1950s, the average has been about 4.5%, or just over that. And so we're at 5.25% right now, which is not that high off of the average. So we expect to see some mild rate cutting. We don't expect to see significant rate cutting unless we really get into some economic trouble. The last time that we had more of a rate adjustment than an actual, significant rate cut was back around 1995. And what followed that in 96, 97, 98, 99 was really good market growth, because we had some market stability. We had kind of what we could expect the rate norm to be. and people were able to, were able to really continue to grow what they had, grow their wealth, and make purchasing decisions with that stability. So that may be what happens, and that actually may be the best case scenario, even if it means we don't get those, great 3% mortgages again. So where would we put ourselves right now as far as the market cycle? When we look at the economic cycle, the economy is constantly going through this cycle of contraction, recovery, and expansion. And so when people have gotten to a point where they have the things that they need with some of those durable goods, they get to a point where prices get high and they start looking for alternatives, looking for ways to save money. What that can result in is economic contraction. And so we end up with a recession, we end up with negative GDP. And so for a short period of time, we feel that pain. And then once the market has sorted itself out, kind of come to a little bit of an equilibrium, then we have that recovery period. And so during the recovery period, we tend to have very good prices on things. We tend to have people starting to make a lot of more money more quickly, a lot more opportunity, and we see this growth to a peak. Once we hit that peak, then we go into this expansion cycle. And so it's where things just kind of calm down and we have a bit more stability. We have inflationary pressures, which we've definitely seen, but we can go through a long period of time of expansion before we hit that point where the economy then, just gets bloated and has to contract again in order for us to go to get back to that recovery cycle. We've been talking for a long time about that soft landing, and can the Fed achieve that soft landing where that contraction period is, a bit gentler. So right now, when we look at what Fidelity is looking at, they put us about the middle of that expansion cycle. So in their minds, we could have a long period of time of just that good, slow economic growth, and and a little bit of relief from inflation before going into a contraction period. So a lot of people look at that and say, with interest rates as high as they are right now, with interest rates generally being pretty safe, and especially having those high short-term interest rates, is now a great time to lock in that security, to get into those high interest rate fixed income CDs, bonds, something like that, where they're going to be able to make that rate over a period of time versus, the volatility that you'd see generally in the market. And so I wanted to, have this slide for you to look at and consider of periods of time in the past when CD rates have hit that high and that peak, and what other sectors of the market have done in the subsequent 12 months. So on this chart, if you look at the green, that's the S&P 500. If you look at the light blue, that's a 60-40 portfolio. So 60% equities, 40% fixed income. And so you can see in these different periods of time, what's happened in that following 12 months. And maybe that gives you a little bit of information as far as the value of trying to lock in fixed income and, take that, that fixed 5%, 7%, whatever that rate may be, and lock that in versus investing in the broader market. And even if that means investing a little bit more safely and doing something like a 60-40 portfolio. The other question that we get, and this really comes to a question of market timing, is if we're hitting new records in the market and if we're seeing the market, just achieve these new highs, is that a time to cut back our investment in equities and focus on something else? And, and to say, okay, great, it's grown a lot, it's hit that peak. We know it's going to come back down. And generally in any 5-year period, you're going to have at least on average 130% drop. So there's always that temptation to look at it and say, is this it? Are we at that point where we're about to have that significant drop? And so this chart is it's broken up into two pieces. The one on the left is all-time highs that have become new market floors. And what we mean by a market floor is that, yes, the market has had that drop, that subsequent drop in the future, but it hasn't dropped below what that previous high was. And so if you look at this, you're going to see a lot of those dots, a lot of those points where the market hit a new high, and then that became the floor, and the market did not come back down to that point again. And so that kind of gives you an idea when you have these new market highs, is that truly a risk of now you're about to have a gigantic drop and, and have to take a long time to recover from that? Or is the market also setting those new floors? We don't know. We don't have a crystal ball, but this gives you historic information. The other thing is looking at it historically and saying, let's say you were to invest when the market hits a new high versus just any other day. And when we go back and we look at that and test it historically, on days that the market hits that high, if you were to get in on that day versus just any day, over a longer period of time, we actually historically see higher returns for investing at that new high. That seems kind of counterintuitive. We always think we've got to try to time the market and try to, get in at the right point and get out at the right point and that sort of thing. And really, this is kind of counter to that and shows that, like I always say, the best time to start saving and the best time to start investing is when you're 16. The second best time is today, if you missed that. So, when we look back over the last 10 years or so, and we look at how different sectors of the market have performed, generally what you're going to see is you're going to see a better performance of companies that are producing and are achieving economic results, versus some of their peers that, such as commodities or things that are not actually producing something tangible over time. Gold's a good example. The value of gold and the increase in the value of gold is really based on the intrinsic value that we put on it. Gold isn't paying you dividends. And so why is that? Why do companies tend to perform well? And the answer is that companies are not like gambling. They're not like going into casino and, putting your money on lucky number 7 and hoping for the best. Companies are providing goods and services that people want and need, and they're providing them at prices people can afford and are willing to pay. And so because of that, those companies are, the goal of those companies is to be profitable, is to provide those goods and services in such a way that they can then turn around and reward their owners with that profit. If you look at the S&P 500 growth over the last 50 years, about 40% of that growth comes from dividends, and those dividends being reinvested. The dividends result in a company earning money and turning around and rewarding its investors. So that's what we see in the broader market, is that we see the companies that are producing those things, I call them the deodorant and toothpaste companies, the companies that if you go into a recession, you're still going to buy whatever those companies are selling. You're not going to give up on toilet paper because we have COVID, right? You're not going to stop eating. You're not going to stop using your cell phone, things like that. So good quality companies are providing those goods and services. They're going to continue to, even if they have, down periods and periods of economic cycle, they're still going to have good results over a long period of time because they're providing the things that we as consumers are consistently buying. So what do you do today? As we're going through this cycle, as we're watching what's happening with the economy, what are the steps that you can do in order to help your financial plan? The first one is you want to go through and you want to review your financial plan, get with your advisor and assess the plan. While you're diligently and boldly saving, don't forget other elements that make up a great financial plan. Look at insurance. Look at how are you protecting the things that you've saved, the things that you're earning. What do you have in place to protect yourself from just the various things, calamities, things like that that can happen in life? You want to look at your estate plan and make sure that's up to date. If you've moved to another state, if you've bought another house, if you've added a member to the family, if you've had a change in your circumstances, maybe circumstances that might affect your beneficiaries. your dependents, then you want to go through and make sure that estate plan is up to date. Your will, trusts, and look at other documents as well. Your medical power of attorney. Do you still want the same person to be able to represent you if something happens and you're incapacitated at the hospital? Make sure all of those things are up to date. You want to, now's a good time, especially the second half of the year, to look at tax planning, right? If you want to look at your returns from an after tax perspective, if you're making more money top line, but then you're owing more money to Uncle Sam, and that's hurting your return over time, you want to look at it and see how can you make your plan the most tax efficient. And now's a good time to do that. Another thing is to look at your debt versus leverage. When interest rates are high, this is definitely an important thing to look at. So what do I mean by that? What do I mean by debt versus leverage? And there's good debt and there's bad debt, right? In some cases, it's okay to have debt that you're holding on to because the interest rate that you have on it is so low that you would really have to hurt yourself with other opportunities in order to pay that debt down. In other cases, the interest rate is so high that you're really hurting yourself by not paying it down. Because even if you're diligently saving, you're paying so much in interest on that other debt that it's canceling out what you're putting into those savings. So you really want to look at that and have a healthy balance. You might have one of those fixed rate mortgages paying, costing you 3%. And maybe you don't want to be so quick to pay that down and to do extra payments on that, especially if you can make 5% in a money market, which is a rare opportunity that we have right now. So maybe you don't want to pay that down so quick. But if you have an insurance or a credit card and that's costing you 20%, that's a great time to look at that and work on paying that down. Finally, just real quick, remember why you're making the sacrifices that you are. Remember why you're working towards the goals that you are. Keep that in mind because that really helps you as you're making these sacrifices, as you're saving money, as you're putting that money into your account, making sure that it's invested well and everything. That as you're doing that, you want to look forward to financial independence and what that's going to look like for your family. You want to look forward to those goals, those passions that you have that you want to be able to do once you reach that financial independence. Write those goals down, feed yourself on them, and continue working towards those goals and making sure that your plan is going to get you there. That's pretty much it from the market side. Shelley, tell us what's going on and what's new with our businesses.
Man, that was some great information, Isaac. Question I have for you is, when is my grocery bill going to go down?
That's a great question, Shelley. Unfortunately, I don't have a good answer for you. I have a depressing answer for you. The answer is that your grocery bill is not going to go down. So inflation is the rate at which it's increasing, and while that rate has come down, it's still increasing. So, if inflation was up 9.5% in 2022, and now it's only up 3%, well, that 3% is based on where the prices were last year, and the 4% or whatever it was last year is based on an increase over 2022, where we had that 9.5% increase. So what you're going to see is your grocery bill is going to continue to go up, but it's not going to go up as fast as it has been. So, hopefully increases in wages and things like that will kind of outpace the inflation. But don't expect to see your grocery bills to go down. Just expect to see how much they're increasing to go down.
Oh, okay. Well, of course, that's not the answer I wanted to hear, but that is great insight. So I appreciate that. All right, moving on. Let's talk about your business and what's going on here on the cloud accounting updates at Financial Solution Advisors. So, Intuit, the maker of QuickBooks, the desktop version and online, has laid off about 10% of their workforce. Which I think we're seeing all across the economy and bigger companies laying people off. Intuit has done a great job this year in really vamping up, improving their support. And I fear that the layoff might get us back to those bad support days or those long waiting periods if you have a question or something and need to call QuickBooks. So if you're frustrated when the prices of QuickBooks is really gone a little crazy and they continue to raise prices, please take some time to look at Zero. It's a great alternative and it's got favorable pricing. It's about half of what you would pay for the QuickBooks Online version. Now, there is some conversion if you wanted to move, say, from a QuickBooks Online to a Zero. There's some conversion costs, but in the long run, it can save you so much money. Everyone is hearing about AI buzzwords that even Isaac mentioned as well. And many companies are moving their applications to AI to keep up with the technology and seeing benefits using AI in businesses, which is really, really crucial at this point. We are seeing so many apps that integrate with our accounting software that have adapted AI and are helping clients integrate them into their business. And so we have seen hours of time savings in a day or week by evaluating and assessing our clients to help them choose the right apps that they want to use in their business for those time savings. Which I think, AI scares people. I get it, but it really is the future. And I think it can be used in a healthy way and not the scare tactics that the media tries to put on it. With the accounting market being so tight, to find qualified employees, or maybe some companies have to downsize, just a friendly reminder that we have a department that specializes in outsourced accounting, so we can be your accounting department. We do full, partial outsource accounting, and we can create a package that is customized to your needs, which is really nice. So if you're thinking about, it's time for me to hire a bookkeeper, but not ready for that next step, give us a call. Keep us in mind. And that goes to the next slide, where as business owners, we get so caught in working in our business, but we need to be working on our business, not in it. And so what does that mean? Maybe you have a small business and you're doing all aspects of it. You're doing your payables, you're doing your receivables, you're doing your accounting, you're trying to do sales, you're trying to, make everything run smoothly. Maybe you can do it all. Maybe you need to outsource. So we can work with you in your business. So freeing up a couple hours a week, and it could be more than that in a month. So it gives you the time to grow your business, as well as give you an accurate, real-time financial data so that you make real-time business decisions. What do I mean by real-time business decisions? And how does that help your financial or improve your financial status and help you run your business? It's by keeping expenses under control. I know if you're like me, you might be on the road, you lose your credit card and you kind of lose track of what you're spending. But if you have an accounting software that has all of these systems, the credit card and the banking account connected, you can really stay on top and control your expenses in real time, monitoring your true balances again on your cash in your credit cards, keeping the right things on the balance sheet. We have many clients that come to us for tax preparation and they're like, I didn't make any money. Well, they're expensing or putting on their P&L their building mortgage and their vehicles. Well, that doesn't really belong on a P&L. So moving that onto the balance sheet so you can really get an accurate information on what you're going to owe in taxes and kind of, really see what kind of money you're making. Is so important in business today. So I would just encourage anybody looking or thinking about, give us a call, reach out, because we can help with so many aspects of your business. So I think this has been a great webinar. Isaac, I want to just say thank you. Thank you for all of the information. I know you can't lower my grocery bill, but I was hoping for that answer to be yes. It's just crazy on some of the prices on stuff these days.
Yeah, well, thank you, Shelley. And that's some great information on the business side as well. I always tell someone, I can't do what they do, whatever their passion is, whatever their business is. I can't do what they do, but we're pretty good with the accounting side, and with being able to take those financial statements and translate them to business owners so that they understand, how their business is actually doing and what decisions that they can make as well.
Absolutely. I think that's critical in today's economy and atmosphere on what's going on. It's great to be able to help. I mean, I know your passion and my passion is both is helping clients, helping them get to that next level. So it's something that we
That's right.
really enjoy. And I know a lot of business owners that really don't enjoy doing their bookkeeping at all.
That's
So
right.
yeah. Absolutely. Well, we thank you for joining us today. Again, you can visit our website. And if you have any questions, our phone number is there too. And we just hope that you have a wonderful, blessed day.